I'd like to thank everybody for joining me today. Today, I want to talk about tax planning. Now, when we talk about tax planning, I mean, for our clients and for us, this is the pain of having to pay taxes, and we all go through it. If you think about this, and I don't think a lot of us or even our clients think about this, for most people, the taxes are your biggest creditor. Now, everybody wants to talk about creditor protection and how do I avoid my creditors? Well, taxes are your number one creditor in most cases. So when you start talking tax planning, this could be income tax planning, could be estate tax planning, this could be payroll taxes. I mean, we get several layers of tax planning, but typically most people, when they talk about tax planning, it's how do I, plan around the income tax or estate tax? As we start looking at this, it's one where we need to keep our eye on what the goal is. And with tax planning, there are some very distinct goals here. Number one, can you eliminate the tax? And I should say, can you eliminate the tax legally? Now, when you look at the tax code, it's thousands and thousands and thousands of pages. We've got the tax code, you've got tax regulations, you've got court cases. All of this comes into play in understanding what are the rules, what's allowed, and just understand every time Congress comes up with new tax law, there's going to be tax loopholes. Now, when you look at the tax law, everybody's like, well, it's black and white. The tax code is not black and white. Now, there is some black and white that we have to deal with there, but a lot of the tax code is written gray. So when you get into taxes and working with the tax planning, just to understand most of the time we're working in a gray area. And when I say gray, we don't want to cross the line. And typically I'll tell people if it smells bad, it probably is. So we want to take advantage what everything that we can legally do to eliminate that tax. Just understand the IRS may not like that. The IRS is there to help you write as big a check as possible. So some of the tax strategies that we may get into, the client has to weigh that against what's the chance of not just an audit. I mean, the audit can come from any direction. It can become to people that are doing absolutely everything correct. It's, are you comfortable to be able to move through and take advantage of those strategies? If you can't eliminate the tax, then can we reduce the tax? So it's one, can we reduce the taxes and reduce the marginal rate? Many times, people will come in and say, well, I pay it, an average tax of 20%. What is your marginal rate? Because every time we reduce a dollar, we're reducing it off of the marginal rate, not the average rate. So if to understand that a little bit more, remember the taxes are income tax is progressive. The more income you have, the higher the marginal tax rate. So anytime we can reduce a dollar, we're reducing that from the top marginal rate, not the average rate. If we can reduce that top marginal rate, then of course, the average is going to come down as well. This is one where when we're reducing taxes, we have to be very careful in how we structure that. Sometimes it might be, let's load up on income this year if we've got, basically a low marginal rate. Load it up this year, so next year we can drop down significantly in our marginal rate. So it is one where reducing taxes is our next step. Finally, the third one is, if we can't eliminate the tax, can't reduce the tax, can we defer the tax until next year or future years? And that's where we have to look at and be really honest, with ourselves and with our clients. Are we pushing that to next year and can solve that problem? Or are we pushing it to next year, just creating a bigger problem? So a lot of times we will defer those taxes. And I see this a lot in qualified plans. With qualified plans, remember, you're not eliminating the tax, you're deferring the tax. So if you put money in, into your 401k, a traditional IRA, if you've got a business that has a profit sharing plan, a cash balance or plan that's set up like that, here's the problem. You're deferring the tax. So what's your tax rate today? what's your tax rate going to be when those taxes come due? So I deal with a lot of individuals that deferred, and they're actually now in retirement with a higher marginal tax rate. They don't have deductions, they don't have a business operating anymore. The kids are out of the house, the mortgage is paid off, and they've deferred the taxes from a low tax environment to a high tax environment. So, yes, we want to look at all these, eliminate, reduce, or defer, and make sure we come up with a cohesive plan. When I talk to a lot of individuals and business owners about their taxes, we you go back into the investment world, we diversify our investments. Can you diversify your taxes? So we've got a lot of these things that are taxed today. Our checking, our savings, our CDs, our business, all of these are taxed today. Now, remember, a lot of it gets deferred to tax tomorrow. Just remember, if it's taxed today or taxed tomorrow, you've got a partner. Your partner is the IRS because they want their chunk of money sometime. And so when that's paid, you may have $100, but 40% belongs to Uncle Sam. So you just have to be careful with your tax diversification and come out and look at, can we do tax advantage planning? If so, can we get into municipal bonds, Roth IRAs, properly designed cash value life insurance? All of these are tax advantage. You're going to put it in after tax money, but when you let that grow and take that money and access that, it's tax-free access. So you haven't deferred the taxes. There are no taxes when you want to access that money. So tax diversification is something we need to look at for ourselves and for our clients. I like looking at this. I grew up in the ag business, and so this one rings true to me. Would you rather pay tax on the seed, that little bit of seed, or do you want to pay tax on the harvest? Do you want to pay on a little bit or a lot of it? So think about that, taxed on the seed or the harvest. For me, this is a good visual because there again, it comes back to tax planning. We've got to deal with the taxes, but there again, when do we want to deal with those taxes and how best to do it? Finally, the last step is we have this tax savings. And, we always, hear about, people that, save now, invest the difference, all of those kinds of things, those nice catchphrases. Well, if we just saved on the tax money, and let's say we saved 100,000 in taxes from Uncle Sam, now what are you going to do with those tax savings? Are you going to just blow it? And I have a lot of friends that were, especially in college, I had some friends that I just had to laugh because they were excited when they got their tax refund. And they loved getting a big tax refund. They thought it was free money. And I kept trying to tell them it's not free money, it's your money the IRS has been holding all year. You're just now getting it back. So it's not free money. It was yours to start with. You just didn't get any growth on that. So as we get these tax saving vehicles in place, we've eliminated or reduced the taxes. We've saved that tax money. From a business, you can reinvest in your business. You can, make strategic business purchases, cover your buy, sell, key man insurance, employee retention, buy out a partner, whatever it is from the business side. Well, remember on the personal side, we've got tax savings that we can create too. So are you going to, increase your funding for retirement, increase your investments? All of these things are to protect you and your family going forward. But it's one of those, be conscious in where you put that money. Be conscious in your tax planning, but also be conscious in how you reallocate those funds that aren't going to Uncle Sam anymore. So this planning, it's comprehensive. It really affects all of us, both us as advisors and our clients. Can we save more in our tax money? Can we do proper planning? And once we do that proper planning, can we reallocate those funds so that we can even do better? So I appreciate everybody getting on. If you have questions, let me know. And if not, we'll talk again next week. Thank you.